Welcome to today's show. I'm your host, Christopher Calandra. This is the Simply Financial Podcast, episode number 27 of season number 4. I want to discuss today a little bit about FDIC and SIPC insurance programs and explain how they provide account insurance. So to start with, FDIC, it's Federal Deposit Insurance Corporation. It was created during the Great Depression, and it protects things like checking accounts, savings accounts, and CDs in the event of a bank failure. That's rare. Insurance is for up to $250,000 per depositor, so a couple, typically a married couple, it would be up to $500,000 is protected by FDIC insurance. This is an amazing statistic, but since the founding of FDIC in 1933, no one has lost a penny in any bank failure. They have a completely successful track record. No one's lost any money, zero. It's very impressive. What it does not cover are investments in stocks, bonds, mutual funds, life insurance, annuities. And this is a cause for some confusion in the marketplace, near as I can tell, because most banks, maybe even all at this point, they offer some type of financial services separate from the traditional bank products. And many consumers, unfortunately, think that because they got it at a bank, it's covered by FDIC insurance. But if you acquire an annuity or you invest in an annuity or a mutual fund, even if it's through the bank, it's not covered by FDIC insurance. The important thing is that bank failures are very rare. So this is important insurance. It's worked tremendously well since the Great Depression. Very successful program. But bank failures are very rare. In the case that your bank fails, FDIC would step in and either cut you a check for the money or deposit the money into another institution that is taking on the obligations of the failed bank. But that's how FDIC insurance works. There's something else that I, as a financial planner dealing in the investment realm, interact with a little bit more. It stands for SIPC, that is Securities Investor Protection Corporation. It's a lot like FDIC, and it's also similar because brokerage companies, Fidelity, Charles Schwab, Pershing, Merrill Lynch, brokerage companies very rarely fail. Even during the Great Recession, where you had a number of financial services company encounter troubles, brokerage accounts were not, for the most part, caught up in that. But if a brokerage company fails, just like banks, assets are protected. Like FDIC, up to $250,000 is protected by the insurance, and in total it provides $500,000 of insurance, but that coverage replaces cash and securities such as stocks and bonds that might get lost because of the failure of the firm. To be clear though, SIPC doesn't protect you from the risks of a investment going up or down. The insurance protects against your certificate of ownership being lost. So if your brokerage account goes out of business, again, extremely rare, you would have SIPC. That cash protection comes in handy and is very appealing to investors that participate in brokerage accounts, which are extremely popular in today's marketplace. A quick note is there also is a program for credit unions. It's a little bit of a mouthful. It's the National Credit Union Share Insurance Fund. It has some initials attached to it too, but I'm not sure how you even say it. I don't know how much of a market share credit unions have today, but suffice to say, if you have a credit union, the insurance program is very similar to FDIC, so those assets are typically protected as well. So that's a quick explanation of FDIC and SIPC insurance on your accounts. If you have not subscribed to this podcast, the Simply Financial Podcast, please do so. That would be great. And if you want more information about me and the rest of the team at Elliott Wealth Management Services, please check out our website, www.elliottwealth.com. Thanks so much. I will be back with you on the next episode of the Simply Financial podcast very soon.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.